It's Sunday, January 23rd, 2022. This is all about your Benjamins and your weekly mixtape. Hope you had a great week. Gonna do something different today for the mixtape. If you're watching this on the blog, you see there are no articles down below for weekend review articles. I decided to skip that this week, and I wanted to put on my financial advisor / investor hat. I used to really be into researching the market and portfolio analysis, and I still am, but I've just kind of adopted a more diversified passive with a little bit of tactical management for my retiree to the portfolio. So I don't spend as much time diving super deep into the markets rather than just knowing what's going on and how it applies to the plans. But you can't see this, but on my iMac over here, I've got a bunch of charts up. They'll be flashing up throughout the video, so eventually you're going to see them. But I wanted to talk about the market because I have a feeling this is going to become more and more of a conversation in the next week or two, just where things are to begin the year. So we're almost done with the month of January, and the markets have not gotten off to a good start. We've had a lot of headline news in the form of inflation, Ukraine and Russia now. We've got the Fed talking about raising rates. We've got Omicron and COVID creeping back up. All of these headlines that has provided a shaky market, interest rates going up, all these things going on. And what I wanted to go over is just revisiting investing and why we have diversified portfolios, why we have global diversification, why it's better to have a plan and not try to react. And in some ways, the charts I'm going to show and some of the things we're going to talk about, I hate doing because it's the same thing that all of us financial advisors say to our clients. And sometimes I fear that clients think we're just saying that and we don't have their best interests in mind. But ultimately, I've been doing this almost 18 years now, 17 and a half years. And I've been through various market cycles. I've been through 2008, 2009. I've been through COVID, 2017, I think it was the end of the year. I've been through the short-term declines in markets, and it's never been the best idea to move to the sidelines, which I think people are going to start to feel that way, especially as the media begins to pick up more of this and highlight some things. So I wanted to kind of revisit and give you some confidence as an investor. I'm going to be sending this to my RLS Wealth clients, so this is to them just as much. This is what I would be saying to you if we were in a meeting. I don't want to be too proactive on this and cause more concern because we don't know where things are going to shake up. And depending on what you're listening to, what you're watching, what you own, it may not be as bad as you might think it is. So the first and foremost, I just want to show this chart. Shout out to our friends over at Y Charts. I've been using them for a long time. And this chart just shows different areas of the markets. We've got the S&P 500, we have the US small cap, we have international, we have emerging markets, through the bond market on there as well, and then real estate. Could have gone crazy with more of these lines, but what we can see is they're all moving down and to the right, not up and to the right, which is what we want to see. So this is a year-to-date chart, price change, so giving us returns on these areas. And what I wanted to point out a couple things is, one, the U.S. is doing worse than the international markets right now. And not by much on a couple of them, but we're doing worse than the internationals. And for the last 10 years, let's call it, for the most part, U.S. has been the place. If you were just large U.S. growth, you would have done better than if you had a diversified portfolio. I've had to go through many times in client meetings, going through the holdings we have and why they hear the U.S. markets are up 25%, but they're only up 17 or 18. And it's because we're holding other areas. One, we're not full equities. We've got bonds in there, but we also have international, emerging markets and other areas that create a drag. And Michael Kitces is the first person I ever heard say this, but he always says diversification means having to apologize for something in the portfolio. And the next chart I'll flash up is one that we show a lot in the profession. It's the Callan chart, the periodic returns chart. And this is a shout out to JP Morgan. They have two pieces that I absolutely love, Guide to the Markets and JP Morgan's Guide to Retirement. There is a crypto version out there from my family at OnRamp, which I absolutely love as well. But these documents are updated every quarter, and they have different charts to help visualize investing and help advisors tell the story. So if we go back to the first chart, we see everything going down and to the right. Diversification is working a little bit. You have some areas, declining faster than others. So if you're diversified out, you're not as bad off if you're all into one. The chart that you're looking at now, the Callan chart, shows you the different returns by different asset classes. So some of the ones we looked at in the first chart, but other ones as well. And what you can notice is there's no rhyme or reason to the returns. Top of the chart is the best performing in the year. Bottom of the chart is the worst performing. You look at it and you never know. And a lot of times what you might see is one that was at the top one year is now towards the bottom of the next year. And this is why trying to pick and move in and out of the markets is such a difficult thing to do, is we don't know. There's tons of narratives out there. We can make a guess, but at the end of the day, we don't know what's going to happen. And if you look on this chart, there is a very, very light color. It kind of lives in the middle. You've got a line that checks it, and that's a diversified portfolio. I forget to look at what the diversification is. It doesn't matter. This is all about illustration and kind of education. So what this shows you is that if you have a diversified portfolio, a portfolio that holds all of those colors, broken down into a risk tolerance that fits you and fits your plan as far as getting the goals that you need but not taking on too much risk, while you're never going to be at the top in a diversified portfolio, you also most likely are not going to be at the bottom. And it puts you kind of more in the middle with a more smoother ride. Smoother ride might be easier for you as an investor, less fear, you're not dropping 40%, but you're also not getting that high spike. The other thing that diversified portfolio does, even though we don't know where that average is always going to fall, it gives us a better chance as advisors or investors doing it ourselves to project what we might get a reasonable return on our portfolio, to run that through the plan to see, is this growth going to be the best? Now, this is forecasting the future using back data. It's not perfect. There's no perfect way to do this, but it's a way for us to have an idea of, are we on the right track? Is what we're doing, combining our savings with our investing, with our lifestyle, going to help us reach our goals? Because this is an unknown and there's so many variables that go into this, is the best that we can do, and this is why advisors hang our hats on this. Yes, it is possible to pick stocks and maybe outperform the market, but it's also possible and more likely to pick stocks and do poorly. Let's talk about stocks. Look at this chart. I picked some random names. I tried to pick some of the more popular ones over the last few years that have just been crushing it, and then some more boring ones. So I have Apple and Tesla and Netflix and Peloton, Shopify, Google, JP Morgan, Church & Dwight, AT&T. The last few are your more boring ones, and this is year to date. And you can see here, the high-flying ones that you would have picked after the last couple years because they're doing so well are getting crushed. The ones that are boring, AT&T, Church & Dwight, JP Morgan's down a little bit, those are doing better. So there's growth investing, the high-flying names that are down a lot. Value is kind of more of the names that I mentioned on the second end, and we can diversify amongst those. Growth has been where it's been, where it would be the last, I can't even remember. It's been a long time for the value investors. Are we seeing a change of guard? I don't know. I have always subscribed to having a tilt towards value. Doesn't mean you don't have growth, but you have a little bit more value. And that has created a drag, going back to diversification. But that's using data from a very long period of time that suggests that over the long run, that value will do better than growth. Hasn't been the case over the last handful of years, but maybe it will be going forward. So while it's easy to go on the media or go on social media or even write a book with all this theory about how to pick stocks to do better, it's very hard in practice, even for professionals. And if you're working with a financial advisor, truthfully, they're spending more time making sure that you are getting the income that you need, doing things the right way for taxes, making sure your estate plan's there. Yes, the portfolio is a part of it, but that's not all they're doing. If you want somebody to manage your portfolio that way, then hiring a stock picker or a fund manager is going to be the way that you go. But the data shows that most oftentimes active stock pickers don't do as well as just owning the market. Not always across the board. You might find a rock star here and there. Maybe you have enough to invest with them, maybe you don't. But going back to why are we investing, it's to meet some goals in the future. It's to keep up with inflation, outpace inflation actually. And is it to make as much money as possible? That is dependent upon your personal goal. Most of the people that I talk to, we just want to hit a certain goal in the future, whether that is taking time off from work, sending our kids to college, retiring, going on a trip, whatever it might be. It's not to say I want to have as much money as possible. There are some people out there who have that goal, but that's not the goal of most of us. We just want to live a good life, spend time with people that we love, and enjoy ourselves. So picking stocks is tough, and if you were to follow the trend of the last couple years, early into this year, you would be hurting. Now, does that mean you abandon those stocks? Do they recover? I don't know. Let's talk about recovering and kind of year returns. The next chart is showing the annual returns and then the intra-year declines. So the way we look at this is we can see at one point what was the lowest that the market went, and then what did the market end up for that year. This goes back to 1980. Don't get too caught up in what the actual numbers are. What I want you to get caught up in is every year, even the years we end up 30+% up to the upside, there's red on that chart. At some point during the year, the market is going to go through a decline. and also looked at very few years is the lowest that the market went, so the furthest down on the red where the market ended up. So there's one year we were down 49% and we ended up 38. That's 2008. Why I needed to look at that, I don't even know. But even then we didn't end up at the worst. But there are years going back into the 80s where we were down 34% at one point and finished the year up too. What is this year going to hold? I don't know. And anybody who tells you they know for sure, I don't care what their storylines are, what their predictions are, they don't know. Every once in a while, somebody's going to get right. A pundit's going to guess right, and they're going to run with that, and they're going to be, they're going to be brought on TV. They're going to be called an oracle. All these things, and they just got lucky. They got lucky. There's no way that anybody knows what this year's going to end up after just a few weeks. Yes, there's narratives that are out there. They sound very good. Your political narratives come in there as well. So depending on the party that you follow or you support, that may change your perspective on things this year. And we really just don't know. So part of what I want to highlight is what we're experiencing in January is not abnormal. The S&P 500 year to date is down a little bit over 7%. We're not even to a correction, which is another thing I want to hit to next. Corrections and bear markets and all these terms you're going to hear coming up. What is a correction? For whatever reason, 10% is the magic number, that a 10% decline from the highs is considered a correction. Corrections happen regularly. They happen statistically less than once a year, but the reality is we get close to them every year. Why is 9% not a correction and 10% not, or 10% is? I don't know, they just picked a number. The next random number we've just decided to give a lot of value to is 20%. A 20% decline in the market is called a bear market. Now, when you look at market performance and returns, you can have bear markets in individual stocks, as we saw with some of our high flyers. Tesla, Apple, maybe not Apple. Apple's not. Tesla, Netflix, Peloton, those are all experiencing a bear market, yet the overall US market is not even in a correction. So depending on the holdings that you have or the funds that you hold, you as an investor may be feeling more pain than other people out there. Our investment experience is relative to the funds that we hold and our personal goals and kind of how we handle emotions. So some of you out there might be hurting. Some of you might be watching this video, hopefully a lot of my clients, and they're like, I didn't even realize it was that big of a deal. Sure, I heard the market's down a few hundred points a couple days, but I didn't really notice any change in my life. I hope that's what everybody at RLS Wealth is feeling. I know a few people out there might be getting nervous, and that's perfectly okay. That's why we have a plan. That's why we have these conversations. That's why we'll have phone calls going over this again. But I wanted to share this with everybody. So where we're at in the market is not abnormal. It could go further, and if I had to guess, I don't think that we're done. But then we kind of come into this phrase that you're going to hear a lot, buy the dip. And buying the dip means when the market goes down, when the market dips, you want to buy. That has worked over the last few years. Almost every dip, if you bought the dip, it was the right move. The tough thing is, how do you know when the dip is done? And how do you know if we don't change that, buy the dip actually working? Maybe this time the dip has further to go and buying this current dip is not the right dip. We're not going to know, which is why you want to have a strategy. You want to have a game plan. And you also want to be prepared that, hey, the S&P is down 7%. Sure, it might go down a little bit lower, but I have some cash to put to work that I don't need. It helps out my goal. I'll take a 7% decline. And if it goes down further, okay, I'm okay with that because these aren't funds that I need today. The stock market, and I wish I'd have came up with this, but I'm not clever. All right, we're back. I'm going to restart some of the things. My memory card got full. I haven't had that happen for a while. I need to clean those things out. So, going back to the phrase I wish I would have said, the stock market is the only store, if you will, that when things are on sale, people run away from it, and then they rush in to pay things at high prices. FOMO brings people in to buy the top of the markets, and everybody bails when things get rough. What my job as an advisor is to encourage my clients to not bail when the markets are down low, when they're scared. That's the worst time for us to do it. And part of that goes into portfolio construction, and if we're retired, making sure we have enough conservative funds, even though we saw earlier that even the bonds are down, even though we have enough conservative funds to meet our income needs, so that if we have stocks in our portfolio or equities in our portfolio that are down more, we're not forced to sell them. So again, why you have a plan, why you have portfolio construction, why it's tied to your goals and also tied to your risk tolerance. So anyways, we've seen how the market is going. This is not abnormal. It could go further, which ties into having a plan and also knowing that funds you might need in the short term should not be invested. I know it's easy to get caught up and think that the trend's going to continue, but we don't want to have a situation where you're buying a house or you're fixing up the house or you have a trip and you invested the funds and now they're down significantly and you either have to pull more money out, you have to sell other funds to get there. That's just not good planning. So part of the conversation and part of what I hope helps clients feel better is knowing that, okay, we don't like seeing the portfolio go down. We don't like seeing the investments go down, but that's part of the game. That's the price we pay to get returns to keep up with inflation. And I have enough funds there to cover my income needs for a year, year and a half, which should give us plenty of time to recover because statistically, we bounce back faster than that. Statistically, doesn't guarantee it. So if we take what we know to be historically true and use that as our best, I don't even want to say guess, our best approach to managing going forward, that's the most that we can do. And then we've got to realize sometimes there's some outliers and then we adjust the plan for that. One of the things that you could do and that we do with our clients in retirement, we do have a rules-based portfolio that will get more conservative with time. So I'm guessing that on February 1, the majority of my retirees are going to get a lot more conservative because of the triggers are going to be hit. So you can do some of that so that way you're managing your portfolio that while the markets are doing well, you're not sacrificing growth for the fear of a decline. And if the markets begin to trend down, you have a rules-based way to get more conservative and stay conservative until the rules tell you to get back in. You don't want to use your gut. I think it's a tough way to manage money. So that's one way to kind of not have to sacrifice the growth of the returns that we know will be there for the long term to balance out the concerns that you have and the emotions that you have as an investor. A couple more charts I want to show. One, pulling up, it talks about time in the market. So this kind of talks about why you shouldn't have money in the market that you might need in the short term. On a 1 year, you have the range of the portfolio. If you look out over time, basically what I want you to see is the further out you go, the lower the chances are that you would have a loss in your portfolio. So as you get out 10 years, it's almost non-existent. You go out 20 years, you're not going to, historically, you wouldn't have lost any money. So I just want to show that if you have time on your side, if you're a retiree, you do have time on your side for part of your portfolio. You're not taking a distribution of all of the portfolio today or tomorrow, so you need that money to last for 20, 30 years. That's where the construction comes in, that the funds that you need in the short term shouldn't be in those funds, in the types of investments you need to give a longer period of time to increase the likelihood that you're going to come out ahead. And then the final one I want to show is another one that advisors love to quote and show is just the timing in the market, missing out days of the market. So if you stay fully invested, you can see what a return would have been from 2001 to 2020. And then if you miss the 60 best days trying to move in and out or you let your emotions get where you would go, and anywhere in between, miss the 10 best days, 20 best days, 30 and so forth. Again, I don't really want you to get hung up on the returns or even the numbers for that standpoint, just the concept. The concept of it, that if you miss good days in the market and caught the bad ones, you're going to significantly reduce your opportunity to grow in the future. So while it is hard to stay in the market when the headlines are scary and you're feeling emotional about it, knowing that it's almost next to impossible to time the market perfectly, you put yourself at a disadvantage. Rather than if you have a portfolio that's diversified, hopefully you're not down as much as the markets you're hearing in the news that are spooking you, you are able to stay with that portfolio and ride things out. So I didn't even want to bring up crypto into this. A lot of you probably aren't investing in crypto. The crypto market looks even worse. We are well into bear markets on most of the coins. It's been a couple weeks. Bitcoin is down at 35,000 after being up to 68,000. Extremely volatile. So just take everything that we just looked at least on the returns year to date, and the highs and lows throughout the year, the intra-year returns, and multiply that out to get the impact that's going on in the crypto world. So while I do invest in crypto, we have clients in crypto, I didn't feel like that was super important because the concept is the same there. It's just even stronger, even more declines right now, even scarier for those investors there that aren't investing with a game plan and understand the space. So that may be a conversation for another day. Maybe I do another one of these on a future Sunday and kind of address crypto as I hear more and more of you investing in it. But I know pretty much everybody listening and watching is in the traditional stock market, in traditional investments, which is why I thought this was so important. So I know this is a longer video than usual. I got a little nerdy with the charts. I do have some of that in me. I just have kind of grown as an advisor to realize that spending a lot of time analyzing that stuff is not what's best for my clients. It is the planning, it's the estate planning, the tax planning, making sure insurance is in place, planning for living life, planning for reaching goals, helping my clients figure out what's most important for them and then build their plan around that. That's really where I need to be spending a lot of my time and getting into the weeds. Having an idea of what's going on in the markets, knowing what's going on, making some adjustments along the way is what my clients really need. So it's fun to get into these things sometimes. It's a good conversation to have, but the main takeaway from this is not to create fear, but more to empower you with some information and remind you that the way you're invested may not match what you're seeing or hearing on the news. A lot of people go on CNBC or Yahoo Finance or Cheddar or whatever it is that you're watching with a lot of bold predictions. They have no accountability. They're not managing your plan. They don't care how you do. They are just there for ratings. They're there to hopefully get lucky so then they can write a book or go on a speaking tour. But they can be wrong today and they'll get right back invited next month with another crazy idea that has no accountability. So remember, take that with a grain of salt. Where when you're working with an advisor, if you have a good relationship with them, they care about you. They want you to see, they are being compensated for their work for you. They care about what your plan is. What they're recommending to you is probably going to be more in line with your best interest than what somebody on the news is saying or somebody that you're talking to the water cooler at work who has no credibility to them is saying. So I say all of that not to dismiss how you're feeling, not to dismiss what you're thinking, but there's a great chart out there that I didn't grab for today that Michael Batnick, my friend at Real Holtz Wealth Management, puts out that shows you all of the reasons you could have sold over the years that were great reasons to sell that ended up being blips on the radar. And we've highlighted it before. So don't let those narratives spook you into making a decision that may negatively impact your portfolio. But that being said, at the end of the day, if it is creating that much stress and that much anxiety in your life, then maybe you should make a change. Maybe it's not fully going to cash, but maybe it's lightening up, understanding the risks, understanding the potential impact on your plan. Because this may be another scenario where buy the dip is the right action and we rock it back up from whatever this low ends up being. Remember back when COVID hit, markets declined significantly and they recovered very, very fast, and then they went on a run we've never seen in history in a short amount of time. Will that happen again? I don't know. Probably not to that extent, but we don't know. What we do know is if you sell and you get out and you don't get back in, it's harder to get back in. You miss that recovery and you impact your portfolio. So before you make that decision, fully understand what are the consequences, what does it mean, and also remember if you're sitting in cash, inflation last month was 7%. So while you're not losing on paper, you're losing on purchasing power, which you can't see and measure. The paper losses will recover. I have the utmost faith in that. How quickly depends on how you're invested. If you're in individual stocks, maybe you get lucky, maybe you don't. If you're in a diversified portfolio, I feel confident you're going to recover in a reasonable amount of time. No guarantees to that though. So, all right. I am done rambling. We got to get ready to go to Roman's basketball game today, but I wanted to come on and go over some of these charts. I'm sorry I got this out a little bit later, but some more editing had to go in than usual. Not my normal cut and paste the intro, outro, and then hit record or hit export, send it to YouTube. So I hope this helped. Again, the whole point of this was I think that there's the potential this lasts a little bit longer, and the narrative's going to get scarier. Markets in turmoil is going to come to CNBC. People are going to be chattering, and you'll have a decision to make whether or not you stick to your plan and feel confident with what you're doing and know that you're in a good shape for your plan and your portfolio, or you could get your emotions get the best of you and make a decision that might hurt your plan. As always, all of this is meant to be educational. It's not advice. Talk to your financial advisor. If you have questions, consult your plan, consult your tax person as well if you're making changes. What's the implications of that to your plan? A lot of things to consider as you make adjustments. Hopefully this ages bad and things recover and there's no reason for me to do this, but I just hear more and more being talked about. What we're experiencing now is a little bit different as far as the decline over the last couple of years because of all the headlines that are out there, and we've been 10 years into just a crazy market with a couple of hiccups along the way, so that to be taken into consideration as well. Appreciate you tuning in. Let me know if you have any questions, any other things you'd like to see along these lines. We can sprinkle these in. Maybe I do a different series on All About Your Benjamins where I do a little bit of investing videos from time to time to sprinkle in and then get back to your typical weekend reviews. So have a great rest of your day. Remember, have a plan, be diversified, stick to that plan, and talk to your advisor if you have questions or concerns, and tune out all the noise. Enjoy life. We only have a short amount of time here. Worrying about the numbers, worrying about your investments should not take away from your quality of life, especially if you have a plan and you're doing things the right way. So with that, have a great week, and we'll see you all in the next episode.